Welcome to the Brain Pick a Pro show, live from Lake Wiley, South Carolina, and all the way on the other side of the country, even over the ocean, a long, long ways away, is my good friend Lane Kawaoka, all the way from Hawaii. How you doing, buddy?
Hey Larry, good morning.
What's happening?
Just waking up. It's a little early here. I think we're at 6 to 7 hours difference. So
I think we're probably 6 hours difference, I'm guessing. What time is it there?
it's like 5 a.m.
5? Okay. Yeah, it's 6 hours difference. That's crazy, isn't it?
But that's what you gotta do, right? You gotta wake up and get after it.
That's right. That's right. So why don't you start out and tell our listeners a little bit about yourself?
Yeah, so my story is I'm still working a day job, full-time engineer. But I started out with a lot of people going to college, and with that program inset, go to school, get a good job, work at that job for
Right.
50 years, and maybe have enough. But my path kind of diverged pretty early. I went to work out of college, and I went to work as a construction supervisor
Right.
at a job, traveling the country, and I didn't really like it, and it was pretty tough way to make a living. But that was back in 2008, 2009, so
Right.
it was a great time to have a job. So I saved it, I bought a house, and I lived in it by myself for a little while, but I was never home, so I just started renting it out.
Yeah.
So I'm your typical accidental landlord.
Oh, wow.
So I never really, at the time that was A-class rental in Seattle, Washington, $2,200 a month. Mortgage was $1,600. So didn't know anything about that 50% rule or anything like that. But it cash flowed to me, and I was like, wow, I need to do more of these things, and because this is my way of the rat race.
There you
So that
go.
was kinda how I
Tell
got
the listeners,
started.
what is the 50% rule?
Yeah, so the 50% rule is like a shoot from the hip, quick way of determining if you're going to cash flow or not. There's two rules that we like to use a lot. That's the 50% rule. So you take the rents, which in this case was 2,200, and you essentially divide it by half, and that should be your take-home pay after you take out the maintenance, the property management,
Right.
and capex and vacancy.
Right.
It sounds a lot, but hey, this is a very expensive business to run at the end of the day, especially if you have an older property
Right.
that has a lot of things coming back and forth.
That's so true. That is true. That is true. And just so everybody knows, CapEx is the capital expenditures, the improvements, improving the property, right?
That's correct, and I think that's what a lot of newer investors don't realize it's there. I mean, you buy a new property, and you're not going to have a lot of the big components break on you, like the water heater, the HVAC, the roof, the new floors, painting. But sooner or later, it's going to come and eat you. I mean, I have this capex calculator. It's like a spreadsheet of all, like probably 10 or 20 different components
Right.
out there. Like a roof will cost you, I don't know, 20 grand or something like that. But the roof will last you 20, 25 years possibly. So you divide that out by 20, 25 years, and you get a per cost year.
Right.
And you just go down the list, you add them all up, and it adds up. Usually about 10 to 20% a year of your rents you can possibly eat up.
Yeah. It eats up a lot, doesn't it?
It does. And it's usually at the end of the 5 to 10 years down the line of ownership, you're like, shoot, I just gave up all my profits paying for this one thing. So it kind of sneaks up on you.
That's true. That is true. So what's going on these days with you? What kind of, that's how you kind of got started. So what did it kind of morph into?
Yeah, so I bought another rental in Seattle, and that was in 2012, and I realized it didn't really cash flow, and I had a lot of equity in those homes. So
Right.
I think as real estate investors, you need to look at something called return on equity. The saying that your cash flow is really no indication of a good investment at all. I mean, I can have 100% cash in the deal with no leverage and be cash flowing. But my return on equity could be very, very low, 1, 2,
Right.
3%. And
Right.
at that point, I might as well be in a savings bond or something like that.
Sure.
So I took a lot of that equity, and because stuff wasn't cash flowing in Seattle primary market, I went to a secondary market, and I did a 1031, and I did nine. Sold 2 properties, and I got 9 properties out of state in Birmingham, Atlanta, and Indianapolis. So I did that, the turnkey rental thing. Bought it through a turnkey provider, and then I bought the rest with using a broker once I kind of figured out what I was doing.
Right.
And that was got me to double digits in single family homes. But then I realized it just wasn't really scalable. I mean, at a few $100s of cash flow per month on each of these houses, that was only about $3,000 passive a month, and that wasn't going to reach my goals. My goals are more like 10,000 a month is
Right.
a pretty decent cash flowing number, I think.
Sure.
But do the math, I would need 3 times as many houses or 30 houses, and with 10 houses, I was getting an eviction or 2 every year, and 3 or 4 big issues that came up, like a $4,000 HVAC, or big couple $1,000 plumbing repair or something would
Right.
pop up 4 times a year. So you do the math, 30 houses, now you're talking of eviction every other month and a big catastrophe pretty dang often. So it just wasn't a scalable way of investing.
Right. So what did you do?
So at the time, I started to network with, other investors that are kind of similar to me, a lot of, doctors, lawyers, engineers, but, that were 10, 20 years ahead of me. And they were all investing in apartments and syndications as limited partners. And yeah, the returns weren't as strong as when you're being the direct operator.
Right.
But a lot of that is just kind of trading your time for money or sweat equity.
Sure.
So what I realized is I was like, well, I got to a point where I was like, well, if I get 15 to 20% of my money every year, then I'll definitely reach my goals. It'll take a little while, but I'll get there. Why do I need to be the direct operator and do it myself? And, at the time I was, kind of studying to analyzing these big deals, which is totally different than single family homes.
Right.
But I just went into deals as a passive investor, and that's kind of where I've been, specializing these last couple of years.
And you know what, Lane? Not many people really think about that as being a real estate investor, but it's a great way if you have a full-time job or you have a career that you're doing, that you're working in, and you like what you're doing, but you also want to invest passively. So it's a great way to be able to get passive income and grow your assets and your net worth, because you're not only getting passive return, but there's a payday at the end of the deal which bumps that up to the 15 or 20% you're talking about, right?
Right. I mean, what I like about it is you're getting that cash flow, right? A lot of deals out there, like development deals, you don't really get the kicker to the end, and
Right.
then you kind of cross your fingers, right? It's a speculation.
Right.
I like these deals where, like, apartment building will be 90% occupied. It'll qualify for non-recourse debt,
Right.
and you can get into the deal, and it'll cash flow for you because it's a stabilized building.
Sure.
Yeah, you're buying it because the old owner just didn't run things the best way.
Right.
But if a recession should come, at least you cash flow at 5 to 10% annually,
Right.
and you have that force appreciation potential to kind of ride it out. Maybe you won't get your you won't sell the asset in 5 years, but hey, you'll be better off than everybody else, and sell the asset maybe in 8 years or something. But still cash flow in the process.
Right. That's really good. So, Lane, how do you go about finding the promoter that you want to invest with?
Yeah, so I join different masterminds and go to conferences. It's really the good old-fashioned way. I mean, I think, Skype like this is awesome, but it really makes no no substitution for in-person meetings.
Right. I agree.
And what I also recommend is, it does you no good to talk to the promoters or the sponsors or, syndicators.
Right.
Um, those three words are all kind of the same thing.
Sure.
Because you're going to get the same dog and pony speech every single time. What I would suggest folks out there, if you want to go down the limited partner route, is to go and build your network of other limited partners to figure out where people are putting their money into. So you can get that unbiased opinion.
Right.
Because for me, that's my biggest asset these days is, I just have so many people where I can go to, hey, did you hear about Bob's deal, or, have you been in Jerry's deal in the past or something like that?
Right. That's good. So what are some of the things you look for other than talking to other limited partners? What are some of the things you look for when looking at a sponsor or promoter?
Yeah, I think when you look at a deal, it's half of it's the person, right? So what I always talk about with other people is like, well, what is our track record? Have you got your money? Have you got what they said they were going to give you?
Right.
And because you're always trying to check what kind of integrity they have or character as a person, right? A lot of times a deal go bad, or if a deal goes bad, are they going to kind of step in and, put their own money in the game or make things right with their investors, even though that PPM doesn't say they necessarily need to,
right?
Just to protect their brand, or, it's a big thing. But the other half is the deal, right? Like, the numbers make sense. Are you getting the P&Ls and the rent rolls, and you're going to chug those numbers yourself? Or are you just taking everything in the executive summary, which nothing in the executive summary tells me if it's a good deal at all. I don't understand why they even send it out, but people think that's a way of analyzing the deal. There's nothing in there, I think, that tells you
it's all negative.
If it is. I mean, it's all pro forma.
Right.
You need the past profit and loss statement from the last 12 months at least.
Right.
You need the rent rolls, and you need to do your own comps.
Right.
And you need to ask yourself, hey, what's the business plan here? They're going to put $3,000, $4,000, $5,000 of rehab into each unit. What's the capex plan? I want to see an itemized list of all the what they're going to do. And what is that going to equate to? Is it going to be a $50 rent increase per unit, $100 rent increase per unit?
Right.
And then you're going to ask the question, is that going to absorb? And put it into your own analyzer to figure it out.
That's really good. So most of the deals you're doing sound like they're multifamily. Are you doing any like student housing or senior housing? Any of those? What do you think about those markets?
Yeah, so I started in apartments, and that's kind of where, that's my comfort zone. I know every little trick in the book to kind of, put out your own deal. So reading those things, I know, but I've been getting a little heavy into multifamily, and I feel multifamily is a little overheated these days.
Yeah,
it's just really hard to find deals.
I agree. Everybody's chasing it right now.
Yeah, I really like assisted living, but man, that's a different beast. The senior housing, that's more an operator.
It's a business instead of an investment.
Yeah. I mean, an apartment building, you can kind of be an idiot and buy in the right market and look like a genius.
Right.
In 3 to 5 years. Assisted living is definitely not like that. It's a little more hands-on. I haven't found too many operators that have done more than 2 of those things. I don't know what happens.
Right.
They just give up or something like that.
Right.
But you mentioned like student housing. I'm not a fan of student housing or military housing. Near military bases. I just think it's a little bit too speculative, too based on one type of demographic. I like ones that are a little bit more like general public. Just more on the bread and butter industry in the area than to rely on something like that. I mean, student housing, I think one thing I went to University of Washington, and if you look today, they just doubled the student housing around there, and it's all because it's everything's all fake money. It's all fatty, or what is that? Sally Mae, I guess.
Right, right.
I mean, that could just come in and, wipe you out. I mean, it goes up and down. So I'm not a fan of that. I mean, maybe I would do a deal or two, but I wouldn't put all my eggs in that basket. I mean, that's the nice thing of being a little apartment.
Right.
You go into a deal at 50 grand a deal, and you can kind of try everything.
That's good. That's good. So, is there a specific number of units that you typically like to see, like 75 to 150 or 100 to 200 units or something like that?
Well, I think what you're trying to do is, two things. You're trying to get above the mom and pop investors, because mom and pop investors aren't really good. They don't know what the heck they're doing, and they overpay for everything. So you need to get above about $1 million purchase price. So we're usually buying these things at $50,000 a unit.
Right.
So, $1 million divided by 50,000. It's a little early for me here, but you've got to get above that $1 million, and that 50
Well, that's
unit
only 20
mark.
units, but really, what I have seen is most syndicators want to be at least over about 75 or 80 units over that, because it allows them to bring in an outside property manager and be able to pay for them. What do you think about that?
Right. Yeah, usually that happens around 50 or 60 units, so you can get that in-house staff.
Right.
I syndicated a couple deals, and from my opinion, it just doesn't make sense to do a syndication with a PPM. That PPM is private placement memorandum, and that costs $10,000 to $15,000 for a lawyer to draw up.
Right.
Pretty expensive costs.
Right.
And that doesn't really make sense until you start raising more than like $600,000.
Right.
So until you do that, it really doesn't make sense. So, that's kind of your bottom rung. Your top rung, you want to stay below the institutional players, and they're about $8 to $10 million, and they're starting to come into the picture.
Right.
So, anywhere from $1 to $8 million is kind of the sweet zone that,
sure,
more sophisticated. At the end of the day, we're still mom and pop investors, but, more sophisticated sharpshooters in the area.
Right. That's good. So you've actually done a couple syndications yourself where you were the sponsor?
Yeah. I started with a little 52 unit, and then, going to like the 114 range.
Uh-huh.
But I like those little smaller deals instead of the 200-300 unit buildings. I think that's a good economy. You get the good economy of scale, and I think it gets to a point where you're not competing with the bigger boys at the 300 units.
Right.
At those levels.
Right. That makes sense. Tell us a little bit about some typical returns and how a lot of sponsors structure the returns for their passive investors.
Yeah, so everything's backwards engineered to the return at the end. So, if you would have asked me a few years ago what the typical returns are, the tagline that everybody liked to use was double your money in 5 years, or 100% total return on investment in 5 years, made up of cash flow and the refinance or sale at the end.
Right.
That was kind of how you evaluated it. Kind of like what's your how much distance did you travel in 10 seconds kind of a thing.
Right.
In a race car. But, these days it's a lot harder to get. There's not that many deals out there, and the deals aren't that great. So I would say you're probably looking at 80% in 5 years is kind of the gold standard.
Right.
But it's really misleading, because you can cook the numbers as a syndicator and pull all these levers to get at 100% on the piece of paper. Just one example is like the cap, using a different cap rate reversion or the exit cap rate on your spreadsheet.
Right.
So for example, you should say your building is running at a 6 cap, and the prevailing market's at a 6 cap. You want to assume that the market in the future, when you sell, say 5 years later, is going to be a softer market. So a good general rule of thumb is to bump that up by 1%. So to use a 7% reversion or exit cap rate on your spreadsheet.
Right.
Now, if you if you drop that, get a little aggressive and screw around with your numbers and turn that into a 6.5 cap instead of a 7,
Right.
You could get that 100% year and 5-year deal. But if you underwrite it properly with a 1% increase, that 100% deal goes down to like 70%. So you just, got 30% right there by changing just that one number.
Yeah, and if you're talking about 100 units, a 0.5% in the cap rate could make a huge difference.
Well, it doesn't in terms of percentages, and that's what the investors are looking for. Everybody is going to buy in and buy a piece of the pie, and the way investors look at it is like, they care more about the percent of what their money goes in, how much it goes up.
Right, right.
So whether they put in 50 grand or 250,000, it really doesn't make much difference. I mean, it's the same percent increases they're getting.
Sure, sure.
Of course, you can't just put in $10. Usually the minimums are about $50,000.
Right, and they're usually either accredited or sophisticated investors.
Right. Accrediteds can pretty much get into any deal. Sophisticated, you need to build a relationship with the sponsors.
Right. That's good. So how would you suggest people go out and start looking for these types of deals?
I would say, get up and fly to a conference. I wouldn't say that the local RIA is the good place of going. Usually you just got a lot of people flipping houses and doing that kind of stuff. I never found the local RIA to be a great place to go. I could be wrong in that, that's just my opinion. But I think you've got to get to, go into Google and start Googling where these conferences are, and you got to start to pay for this stuff. I mean, this isn't, if you're balking over $20 for a RIA, I mean, you're not going to get anywhere. I mean, the conferences that you probably want to go to are about $1,000 for conference, and
right,
plus your room and your flight over there.
Right. Well,
and the good ones to go to are the ones where people have to fly in my opinion.
Right.
As opposed to, I rolled out of my bed and drove here because I had some time.
Right.
After work.
That's a really, really good point. Do you have any conferences in mind off the top of your head that people should look into?
Yeah, I go to like the real estate guys. They've got a podcast, Real Estate Guys Radio. Yeah. They've got some good ones.
Yeah.
Secrets of Successful Syndication. I'll usually go to that one.
Uh-huh.
Good group of people. But then you also kind of want to go to different apartment ones if you're into apartments, or if you're into self-storage ones, or assisted living ones. I just had Gene Garino on my podcast recently. Good. He's a assisted living guy.
Yeah. He's a good friend of mine. I know him. He's a good guy.
Yeah, you really got to niche down and figure out, who are the players. And once you get into it, it's kind of amazing what a small world it is. I mentioned building your limited partner network. I mean, I'm kind of to the point where, like, if I don't know someone, it really doesn't make sense to work with them, because it's like, why? There's so many good people that that everybody knows, that it's not really worth it to go off the beaten path.
That's a good point.
It's really all the same 300 to 500 people running around doing deals. I mean, there's not too many people doing this.
That's true. Just given the fact that you either have to be an accredited investor or sophisticated investor, and the amount of money involved, it's not going to be your average newbie, RIA type person that just wants to learn how to wholesale houses. It's a whole different crowd, isn't it?
Right. But that's kind of a shame, right? Like, I mean, I think, like, the most, like, the guys that need these kind of deals the most are probably like the unaccredited guys, that $100,000 net worth to $1 million net worth range. I mean, those are the guys that need these kind of deals the most, which is unfortunate that the laws are the way they are. That's, they're there to protect the little guy from
Right.
investing his last 50 grand into the deal when he only has $100,000 net worth.
Right.
So it's a little unfortunate, but I think it's coming. I think the whole crowdfunding laws are getting to a place where it's kind of opening things up a little bit more. But the rules are kind of there to keep the country club in a way.
Yeah. You're kind of like the good old boys club.
Yeah, yeah. I mean, you can go on a crowdfunding website and pick from a menu, but you don't know the person. A lot of times those things are kind of like online dating for guys who can't find investors in a way. I mean, if they could just go in their network and put it out to their list, they could get it funded. But no, they have to go to an intermediary to find their investors.
That's so true. That is true. Well, man, this has been some really, really good stuff. Lane, if somebody wanted to reach out to you, how would they get up with you?
Yeah, you can. I'm open to emails. Lane@simplepassivecashflow.com, or check out my website, simplepassivecashflow.com. I also have my podcast, which I've been kind of diarying what I've been doing the last few years, and that's also at Simple Passive Cashflow on iTunes, Google Play, and all the sorts. So yeah, thanks for having me, Larry.
That's awesome, man. I really, really appreciate you being on today, especially so early in the morning for you.
Yeah, thanks.
That's good, man.
No
Any parting words of wisdom for our listeners?
Yeah, I would say, figure out what you guys have to work with. Gary Vaynerchuk, one of these online mentors I follow, he always talks about self-awareness. So I always break that down to 3 components, the 2 of which are the most important. Where are you in terms of how much time do you have? Do you have a full-time job? Do you have no job where you got all the time in the world? And how much money do you have? To the point. This is real estate investing. If you don't have money, you got to go out and make money, either at a job. Some people sell drugs. Some people do, sell things on the internet. You need money to sort of invest. So you got to tailor your real estate strategy to what you have in terms of money, time, and also what kind of knowledge or network do you have.
Right. That's really good words of wisdom. I appreciate that, man. Thanks so much for being on. It's awesome. It's been great. It's a little different than just flipping houses or marketing or doing direct mail, but it's something everybody needs to hear. It's a whole new world out there, isn't it?
It is. It is.
That's awesome, man. Thanks a lot. I appreciate it. Go get some rest. All right. I'll see you later.
All right. See you later, Larry.